how much more in terms of the participation rate is possible? Because that's key in holding down inflationary expectations. I don't know anyone who would have predicted. I mean, I look at what Zandy said 2 years ago, Mark Zandy, that, we're already basically not going to be able to really add jobs anymore because we're already sort of at full employment. Somehow, 312,000 people were somewhere. Some of them came out of the participation rate. I'm not sure what else, but how much higher could we go on the participation rate? Because I thought everyone was old and retired.
It really shouldn't be too much higher.
Why not? How many are 25 to 54? I thought that's a big number.
They're growing, but I mean, they're really offsetting just the baby boomers who are moving out and kind of aging into retirement.
So we stay here for the participation.
I mean, you could see another tenth or two because one of the areas that's still weak is the core prime working age males are still kind of sitting. There are more of them still sitting on the couch than there used to be. They're not really actually kind of trending up at this point. So the move we saw was actually in other demographics. So if we see a sustained improvement in the U.S. economy, we get 3% next year or this year for growth. Maybe we see a pickup in productivity. Kind of things all kind of line up properly. That number should come up a little bit, and that's where the upside risk.
Okay, then if we had a big wage gain, the biggest in years, well, not big enough, obviously, but what the year over year was 3.2% or something, right? So if we got no more workers, which is what you're saying, and wage gains are starting, then inflation should be something the Fed needs to keep an eye on. That.
Well, I think the main reason the Fed's been moving the way it has is because they're looking at that unemployment rate. And while everyone looks to Greenspan's time in the 1990s and says, wow, he made a great call on productivity then, I think what this Fed is looking at is the 1960s, and they're saying at that time everyone thought inflation was dead, unemployment kept dropping lower, and we sat around debating how low it could go. And then we ended up with an inflationary environment. This Fed doesn't want to fall into that same trap, particularly given the size of the balance sheet and low interest rates.
But oil's looking better today in terms of the bulls, I guess. But you look at a lot of things. It looked like in terms of risks that the Fed needed to take into account, inflation still didn't seem to be the primary risk. And so and since they have no idea what neutral is, in my view, they don't know any better than anyone else. The autopilot for this year, with copper down and oil down and the German bonds at 17 basis points and Japan going negative again, it just didn't seem like you look like an enemy of prosperity when you're on autopilot and you don't see any inflation. Their other mandate is full employment. Let it ride. Why not let it ride?
Well, they don't know where the neutral rate is.
Well, they know they don't. Why do they think they do?
Well, they don't. I think actually this regime does not believe they know where the neutral rate is. They think they have an idea of it, and my best guess as to where their idea is, based just on the dots, is that it's higher than where we are right now.
I get that impression too. I'm just not sure it's the right answer.
Well, what that does is it allows them to go very, very slowly, and that's what they've been trying to articulate, and the market's been pretty much ignoring them, trying to just give that sense of uncertainty that they have. That's not a bad thing that the Fed's uncertain, particularly if they're responding to that uncertainty.
Okay, so Belski, what was your target for 2018 on the S&P?
2950.
So now you're 3,000 for 2019. Is that correct for the S&P? So from here, that's a pretty good move.
It is, and I must say that, 2018 was incredibly humbling for the bulls, right? And so I'd like to give a golf clap to all the bears out there. You've been right 6 years out of the last 30.
Well, no, and I love them. I love the perma bears because they pick on you, and it's harder to be a perma bull than a perma bear. But they're like right once every 30 years, and yet they still take victory laps.
I would say that the whole term perma bull.
And they're not even right half the time because when it comes down, it doesn't come anywhere close to where they got negative in the first place.
I guess the thing that we take serious is most of the bears think they're smarter than everybody. Number one. Number two, they probably never sat across the table from a client that they've managed money for.
I don't think they have any clients, most of them.
Well, when you manage money for people and you lose money, it's incredibly humbling, And, the good book tells you to act justly, love mercy, and walk humbly. You need to walk humble. The true test of a person is how they handle adversity, not success. So the Bears are right last year. Guess what they're doing? They're pulling their muscles, patting themselves on the back. In the meantime, people are losing money, and I think that's wrong. And so the true fundamental construct of the United States stock market with respect to earnings, cash flow, and balance sheet still remains very strong. So yeah, I feel very comfortable. I have conviction in our 3,000 target for the S&P 500. We had to revise it down from 3,150 just because of what the market did in December, but we remain bullish on America. We remain bullish on profits, and we think we've seen irrational exuberance to the upside. Now we've seen irrational stupidity on the downside.
What do you think's happening to multiples? I think this whole situation is the multiple story at this point.
Well, it's a great question, and here's what I would say. Valuations are probably the worst metric in terms of future performance of stocks in the market, number one. Number two, the multiple valuation is one of the least predictive segment, right?
That's fair.
But what I would say to this is that the multiple already came down before the correction, right? Because earnings went up more than price in 2018. Many people lose face of that because the majority of the upside, Andrew, as you know, for the 10 years, the multiple expanded. I think earnings are going to be positive.
Yeah, I'm more interested in earnings than the multiple.
This is a growth.
We were at 8% in terms of earnings growth. Now people are saying the whisper numbers. People are 0 or negative. No. Is it 0 or negative?
The average earnings growth rate for the last 20 years has been 6%, right? I think that we're going to be somewhere in that 4 to 6%.
So we'll be positive.
We're going to be positive.